So again, welcome everyone to, I think we're at week 4 now for our class. We're going to be covering chapters 4 and 5 tonight. And so the first portion will be on self-insured plans, and then we'll go into retrospective rating plans as we talk about that. Of course, chapter 4 is a little bit shorter on the self-insured plans. I do encourage those that will be listening online to the recording to definitely take a look at the Q&A for this week. There's actually quite a few questions, even though it's a short chapter, that you certainly want to take a look at that. And it really helped your understanding of how self-insured plans work, what's the advantages, disadvantages, as well as when we talk about group self-insurance and how that might work. Of course, we did talk about some of that to a certain extent in the last couple weeks on some of the sessions, and you kind of see how all these things really do tie together. And then when we go into retrospective rating, the same thing on the Q&A, we'll certainly be able to help you out. As usual, any questions, feel free to type those in, and we'll go ahead and get started. So for tonight, the objectives that we do have on here, be able to describe the purpose and operation of a self-insured plan, and then also be able to describe 2 types of self-insured plans, and then describe the administration of individual self-insured plans, and be able to talk advantages and disadvantages, and finally a case study. Typically, when we talk about the advantages, disadvantages, we're going to be talking about tax implications a little bit more, and also the administration. Those are probably the key elements when we talk about self-insurance, because a lot of decisions have to be made that when an organization decides to self-insure, of knowing what the rules are. And the administrative burden in some cases might be a reason why they may go to a high deductible program just because of the time requirements of it, and also leads itself to really at that point, if you're going to self-insure, you truly need to have a risk manager on board that would understand the operations. Most organizations, if they don't have a risk management, they probably won't even go to the self-insured route in the first place. So when we talk about self-insurance, what are we talking about? So self-insurance in its essence, it's a form of retention in which an organization records its losses and maintains a formal system to pay them. So, and that's the key element here. A lot of organizations, what we'll call informal retention below, they may be paying for claims, or they may be doing some type of retention or informal way, and they don't have a real formal structure to do that. So when we talk about self-insurance, we're going to have a claims administration, we're going to have to file forms with the state, and so we actually have a structure that helps support that. Now below it talks about a contrasted with informal retention. So that's where we're going to pay for losses with cash flow or liquid assets, but does not anticipate losses and does not involve a formal payment procedures or methods of recording those losses. And so the example I give on this is that informal retention is that you buy food from a restaurant, or you go out and you get sick, and you call up that manager and you say, or the store, and said, hey, I got sick off this, and they say, well, here's a gift certificate for $20 the next time you come in, or they refund your money and they give you the gift certificate. That's really a form of informal retention, because there's not a process of they're getting your name and getting a claim waiver so you don't file a future claim. To a certain extent, it's go-away money. It's something that's seen as inexpensive and a way to retain a person as a customer. And that money, a lot of times, is coming right out of the cash flow of the organization. And so when there's no formal process, things like that, when people have a complaint and they get a gift certificate, things like that, that's really the idea of informal retention. The organization is still losing money, and it's not going through a formal insurance plan, and that's how that would typically work on there. When we think also about what's the operation of a self-insurance plan, what's the best way? Self-insurance is best for losses that are high frequency and low severity. They're predictable. This goes back to the whole idea of retention. So anything that you want to retain a risk, you want to make sure that it's those high frequency, low severity losses. So to a certain extent, auto insurance would be considered that. Workers' comp, for the most part, would be considered something that you'd want to self-insure, and that's where you typically see most programs. It's also typically covered, you're going to have excess liability to cover those severe losses. So just like with workers' comp, University of California, our self-insured retention is $5 million, But then we have excess coverage on top of that. So in the event that we have a severe catastrophic type of loss, that's where the excess insurance would typically kick in. And so most programs are going to have some type of excess liability tied in there for those type of situations. Again, self-insurance is also most appropriate for organizations committed to risk control and can tolerate risk retention and willing to devote resources to manage the program. So when we talk about self-insuring, if you're not going to control your losses or try to prevent them, there's really no reason to go self-insured because there's no benefit to you. The whole idea of having a risk control or risk reduction program is that you'll recoup those benefits very quickly. Rather, if you think about the insurance programs, if you buy insurance, and you have a risk control, the person who really benefits at that point is the insurance company because you've already paid your premium and you're not going to benefit then until you would actually, until the next premium year where you might get a reduction based upon your past performance. So again, when you think about self-insured plans, it's really for those that are committed to risk control and the dedication has to be also in the form of providing those resources to manage. And also, the consideration has to be given the cash flow benefits against tax ramifications. So I'm going to spend just a little more time on discussing this last bullet because they talk a little bit about this in here, but this is one of the key reasons when people look at self-insurance, whether it be a group or one of the trade-offs that they look at. So if you, from a tax advantage standpoint, when you buy premium, so if you buy an insurance program, and you pay $100,000 in premium, that is automatically considered a business expense, and that's deductible in which the year in which you spent that premium. And so basically, but you gave away $100,000, and so you lost the benefit of using that cash for other purposes. If you're self-insured, you now may free up that cash flow, but the tax benefit of, let's say for claims, is let's say you have several claims, and the reserves are for those claims are about $60,000, but you've only actually paid $10,000 on the claim. Well, even though you had to set aside money, retain the risk, you set aside a reserve for those claims of let's say $60,000. You can only claim a tax deduction for the $10,000 which you paid. Because the way the tax code works is that you only incur the expense once you actually pay the claim. By just holding the money for the potential future liability, that's not considered to be a business expense. And so the trade-off that this last bullet is talking about is that you may have increased cash flow to do other things with it. Or in some cases, the cash flow you might have has to be held in the escrow account, so to speak. But you're going to hold this money and you're going to gain interest off of it. But the tax benefit you're going to get of having to hold money in this account, you may not fully benefit from a tax standpoint. So the book does describe a little bit about it, but that is one of the big considerations a lot of self-insured entities run into and something that they have to be mindful of. So this is just an example of when we talk about when you combine with excess coverage, what we're trying to look at here. And so, the loss severity, when we think of low, this is our self-insured plan of what we're going to do. And if you looked at, give the example of the University of California, this would be our 5 million self-insured retention layer. Anything above this would be excess, and that's where excess insurance liability would come into play. When we get to this point, the predictability of these type of losses is, I don't think we've ever had really a $5 million loss. And so the predictability of these type of losses is going to be not very, very low, but then also these are things that would be high, very high loss severity if it did happen. So that's the things we typically try to look at. So what are the types of self-insurance plans that you may want to put into a program? As I mentioned, workers' compensation, auto liability are probably the most common, especially for public entities or even self-insured. Self-insured entities are definitely do workers' compensation, and then general liability. And then all of these other ones may or may not be part of that program, depending on what you're doing. So most private entities will definitely, they'll do, when I worked for Raley's, we had our general liability was self-insured, our auto program was self-insured. And then actually on earthquake and flood, to a certain extent, there's some self-insured retention, but essentially it's more for catastrophic. And then healthcare benefits may also be self-insured. Now, the university just, for our purposes, began a self-insured healthcare program, which we call UC Care. And so what typically happens is that the benefit for us is that we know what we typically paid out in healthcare benefits. And so they're fairly predictable based upon the type of people that you may have in the plan. And so that's where you, from an actuarial standpoint, they can help predict those. And what you're basically doing is you're paying a Blue Cross or Blue Shield to be the administrator, to write the paper, so to speak, so that when I go to a doctor, they recognize that it's part of an insurance program, and all that's happening is that Blue Shield or Blue Cross they'll request, they'll pay for the claims, and we're reimbursing them specifically only for those claims. And so we take the profit aspect out of it for that. Plus, we can structure the program the way that best fits our organization when you do that. And then on the group self-insurance plans, the only ones you can do really for group self-insurance are workers' compensation and healthcare benefits. So with Raley's, we had the work comp program, and the healthcare were part of that, where they were self-administered. And to a certain extent, the auto liability, you can still self-insure on those programs as well. But in California, at least, workers' compensation is probably the most common that you see self-insured groups formed. Or on the private sector side, they're called trust as well, in like New York and other states. But then in the public sector, they're usually a joint powers insurance authority that is formed. I would say in California alone, there's at least 100 joint powers insurance authorities for public entities that are part of that structure. So when you think about your administration of individual self-insurance plans, a couple things you have to keep in consideration of how you're going to do this. And we kind of talked about this in some of the prior chapters, but it's really important when we talk about a self-insured plan. So the first one is funding. So the idea is, how are you going to fund your program? Is it going to be pre-funded or unfunded? Now, the difference in between those two is, if you fund a program, that means you're essentially setting money aside. Your actuary says you need, let's say, $1 million to pay for claims in this year. That means you're going to take money from that and basically set it aside, so it's a funded program. An unfunded program, unfortunately most public entities do this, is that it's a pay-as-you-go. And they may set aside some dollars. They recognize that they need to have some of these dollars set aside to pay for those retained losses, but essentially comes out of operating expenses. Some private sector companies may do this as well. The challenge there, if it's unfunded, that means you're taking those dollars out of operating costs. If you don't fully fund, or what you expect to fund on those. And maybe there might be partial funding. So a lot of times maybe they'll fund at least 50% of the expected on there, but that's where the actuary comes in when we talk about funding. On record keeping, some of the things that has to be kept in mind is, are you going to have a claims management system or risk management information system for record keeping? So what's called an RMIS system. So a lot of people are familiar with IVOS, or the David system. You need to have the ability, if you're going to self-administer, you're going to have one of these systems to basically manage the claims, to make sure payments are occurring, and also it's really to stay that you're compliant also with state regulations on what must be kept as far as records, and to be able to report those to the state of California. For example, if you're self-insured on an annual basis, you'll have to do that. From a settlement standpoint, you also have to consider your third-party administrator. Or TPA, whether you're going to claim on your claim settlement, you're going to hire a third-party administrator, or if you're going to have your own in-house adjusters. So for organizations of a much larger size, a lot of times they will have their own adjusters handle those type of claims. But for University of California, we do hire a third-party administrator to manage those claims. Some of the smaller cities, a lot of public entities that maybe don't have a lot of claims, they may do a third-party administrator for workers' comp, but on the general liability side, they may decide to go ahead and do claim settlement authority in-house, and they will manage some of those claims just because the activity is so much smaller. When I talk about small activity, in some cases it's maybe 1 or 2 claims a month, whereas let's say for workers' comp, an organization of our size, we may be dealing with several hundred claims that are coming in a month, and that can be a challenge unless you have the proper people there. The other issue is to make sure that those people are trained and are knowledgeable on the current regulations and apply them correctly. Then the other piece of this is loss reserves. Part of the administration idea and concerns as if you're a risk manager, this is the aspect you want to look at this, is whenever a claim comes in, let's say someone tripped and fell, and it's a general liability claim, and they tripped and fell on a sidewalk. There has to be a judgment of what that claim is worth. And so even though they may present a claim for, which would not be unusual, let's say $10,000 or $25,000, the determination has to be made by someone or the adjuster of what actually that claim is most likely going to settle at. And so you have the issue of overestimating, which means you're tying more of those funded reserves for that claim. You also have the issue of underestimating, and then which means you're not having enough money, which means then you have to collect more, which goes into stair stepping. So what is stair stepping? Stair stepping is basically that an adjuster may reserve a claim at let's say $1,000, and then they get more information and they adjust the reserve to $2,000, and a little bit more information comes in, they up it to $5,000. The problem is with stair stepping is depending over time, it affects the loss reserves, and depending at what point the stair stepping occurs, from an actuarial standpoint, can really mess up the actuarial reports. And it just, so it certainly has affected. So stair stepping, as you think of, you keep on increasing the claim value over time. What we want adjusters to do, to the most part, is to say, here's what the claim is worth at this point in time. The other issue that kind of goes into this is your excess carrier. I think we talked a couple weeks about this in another chapter, is that once you're, for your excess carrier, they typically require that report a loss once it reaches 50% of the self-insured retention, or once it's going to 50% of what might attach to the excess carrier. Depending on if you're overestimating or underestimating, that reporting period is going to change. And so typically I've seen this with cities or public entities in general, is that they underestimate the potential loss. And so all of a sudden the value goes, and before you know it, they have to report it to the excess carrier when the claim is finally made. And all of a sudden, and at that point, the excess carrier will certainly take on the claim and do the litigation management for it. So that becomes a challenge there. The other thing about loss reserves that you have to keep in mind, and this is where the actuaries come in for those actuarial reports, is what's called incurred but not reported, or IBNR. And so actuaries will put, for lack of a better term, a fudge factor into the loss reserves. So you're going to have your loss reserve estimate, but then you're going to have your incurred but not reported. And this goes right back to the funding aspect, that over a period of time, I may expect 50% losses, or $50,000 in losses, but the actuaries may put an additional $20,000 for incurred but not reported, or a 20%, that's your confidence level in there. And that's really where that comes in. So you'll see those type of aspects are going to be something that you as an administrator will have to be somewhat concerned with. So the question came in, it says, do TPAs or can TPAs provide management reporting services, specifically trend analysis and how your claims are changing over time? Typically the TPAs don't necessarily provide that. What they'll do is the claims management systems will provide information on individual claims. So you can see how an individual claim develops. And this is really the key here when we talk about claims management systems. They are designed to report or to manage claims. They were really not designed as reporting tools. And this has been one of the big issues. That's where the actuaries come in. So the data that comes from there, that's where the actuaries will then do the trend analysis, and they'll do the loss triangles to see how claims are developing. What they can determine, and this is where the actuaries will also look at, what are the reserving practices? So they can see the reserving practices that they're always adding 30%, or they're always doing stair stepping. And so the actuaries will notice this, and they can provide the report to the risk manager to let them know how the claims are being managed, if they're doing stair stepping, under reserving, over reserving. The other thing that comes in is that as a risk manager, one of the jobs should be, if you hire a third-party administrator, is really doing a claims audit. And this is where the claims audit will come in, is that I will then pull 10 files. I'm going to look at them. I'm going to look at, how often was the contact? Did they make 3-point contact within within 48 hours. 3-point meaning they contacted the injured employee, the doctor, and the employer, and so that we have an idea of what's going on with that claim. And then also, what are the reserving practices when they get a new report from the doctor? After they see it, are they adjusting those type of practices? So they really look at the reserve requirements. And then also part of this is actually, when does a claim close? So a claims management audit it really goes against what best practices are, and then also maybe any performance standards that are within the contract. So a very good question on that one. So the other considerations that we have are litigation management. So just like with anything, when you have workers' comp claims or anything else, usually attorneys are going to get involved at some point. And so if an employee does decide to sue, and again, I'm using workers' comp as being the main example here, then you're going to have attorneys. And the third-party administrator may have attorneys that they'll want to use, but typically there'll be a panel, and what's called a legal panel that typically a risk manager is going to want to have, and there's going to be some agreed upon what their fees are, what can they charge. They should have a litigation plan that they have to present on those. The other piece of that is what types of claims then need to be brought up to a litigation, or attorneys need to get involved. A lot of times adjusters can probably handle a lot of the claims on their own, but at a certain point, there's some companies, as soon as the employee gets an attorney, they automatically get another attorney on the work comp side, and now of course your costs are escalating to have that. And the bill review, as it talks about the legal bills, there's a lot of things, unfortunately, that get billed that probably shouldn't be billed. So the risk manager needs to be cognizant of litigation management, of when to settle, and that kind of goes to settlement authority when we talk litigation management, and then also managing those attorneys' costs and making sure that you have the appropriate attorneys with the proper expertise as part of that. So again, another consideration with that, when you work with an insurance company, they have their own attorneys that would handle these types of things, but when you're on your own, you have to be able to pick those attorneys, and so that's just another aspect of a self-insured plan. Regulatory filings, which I mentioned earlier, California requires an annual report. Additionally, with that, there's financial and security fees, and there might be taxes and assessments. So in California, if you're a private sector, you might have to report into the what's called SISF, I think, Self-Insured Security Fund, SISF, which is basically a fund for self-insured entities. So if they go belly up and they still have open work comp claims, SISF, which they pay into, will then help pay for that. Private entities also have to provide a security fee in the form of a surety bond or some other type of security that gets paid to the Office of Self-Insured Plans, OSIP, within the state of California. And most other states have something similar. So what the reason for those financial security fees is to make sure that when someone says that they want to self-insure, that they really have the financial means to be able to pay in the event of several losses. And then also, typically for self-insured groups, they would actually have to have audited financials and some other things that would need to be turned into the state. And so the taxes, assessment, fees is really the other thing I was talking about. And then finally, that you're going to have to purchase excess liability insurance. So the whole point of this chapter is that while self-insurance sounds, hey, that's great, we want to retain risk, there's a lot involved with it. And and all these things are really key elements that will most likely be on the exam of what are the things you want to be consideration. And there'll maybe be a scenario they'll say, your CEO or CFO has a question about doing it. What are some of the things you'd want to consider, or would be part of the consideration of going to a self-insured plan as part of that? So this is basically something that's in the book, and it talks about, at least for the state of South Carolina, and now we're talking about administration of individual self-insured plans and or group workers' compensation. It just kind of shows here's what the filing fees are, taxes, assessment, 2% of total cost. What they call second injury fund contribution is also required. I know the state of Nevada has a second injury fund, and then there might be some specific excess required. So self-insureds may be required to have certain types of insurance as part of this as well. So got a couple hands up, so let me go ahead and grab the person that has their hand up for a question here. Oh, it looks like it was lowered, but the other question is, another question is, who really does the analysis, the risk manager or the consultant? So typically, when you talk about doing an analysis of whether you're going to self-insure, most of the time you're going to probably, it can be done by a risk manager. They certainly would be able to do this on their own to do the analysis. But probably in most cases, if you're sophisticated, you're probably either going to, in some cases, might be an insurance broker might be able to help out because they'll still sell the excess insurance to you, or you'd find an independent actuary. So obviously, Bickmore, who I used to work for, they do what's called a feasibility study, both for self-insured groups, for captive formation, as well as for someone who was looking to do self-insurance. And part of that feasibility study can sometimes be, even if you're already self-insured, about moving to a higher self-insured retention. A lot of public entities may only have a $5,000 self-insured retention, or what's called a guaranteed cost, meaning first dollar. But they probably could retain more risk, and so that's something they'll do is they'll look at, see whether that makes sense, but then they'll also look at, what are the costs associated with either being part of a group, what are the fees associated, what other internal costs, because just to say you want to go self-insured requires some of these things. So, but the risk manager absolutely could certainly do that type of analysis, and that's the reason why it's in this textbook, is to show these are the types of things a risk manager would need to think about and be able to ask these type of questions as they go through it. And a lot of times the state would already be asking these questions because you'll be required to submit who's your TPA or who's administering your claims. So just for those that are interested, if you do a Google search for California Office of Self-Insured Plans, they have a whole listing of everyone that's self-insured that has all the requirements. Everything you need to know about becoming self-insured as far as security requirements, you can basically find on the web, and you can probably find for almost every other state regarding how you'd want to move forward with it. So back on this slide, you can kind of see here they say a surety bond or subject to a minimum of $250,000 letter of credit, and it basically kind of gives you an idea. These are the types of questions that people would be certainly looking at as part of that. All right. So it looks like the phantom hand here. Also, Herb, you have a question. I'm going to go and unmute your line, so I'll let you ask the question. So, Herb, you're unmuted. Go ahead and ask. Herb, can you hear me? Okay, maybe your microphone's not working. I'm going to lower your hand there. So, for those that, if you do want to ask a question, and hopefully your microphone will work, otherwise please call in, and we can certainly open your mic line, and you can ask questions that way. Herb, go ahead and type in your question if it doesn't work that way. So, advantages of self-insured. So why would we want to do this? I'm talking about all these other considerations. Well, the biggest one is control over the claims. We certainly, if you, as a TPA, some of the concerns for those that work with state insurance funds, probably the biggest complaint is that they feel is that the claims are not really being they're not being managed, that they're going through the process, and they're just providing whatever, and so a lot of people feel there's more fraudulent claims in those type of cases, even with an insurance company, to say, well, this one shouldn't be accepted or not accepted. So you certainly, as a self-insured, you have a little more ability to control claims. At what point should they be settled, things like that, to help control costs. So that's one of the big advantages. We talked a little bit about risk control, that the more risk control you have, the better claims experience you're going to have, and that will certainly help control costs, which will make in the long term, which goes long-term cost savings. When you have lower or better experience and less injuries, you're going to have long-term cost savings. And then you also have some cash flow benefits, essentially, that you're not tying up money, giving it to an insurance company. The money that you hold in for your self-insured program is going to earn interest, and so you have some cash flow benefits potentially to be able to use that cash for those purposes. So those are the main advantages when you look at why you'd want to do self-insurance. The disadvantage, of course, we know, is the uncertainty of retained loss outcomes. So if you buy insurance and you're paying $100,000 a year, that's all you're going to pay during that year. If you're self-insured and you have a self-insured retention of a certain amount, you may have several hits at, let's say $50,000, which means you have some uncertainty now about that. So you may retain more. I mean, some years you may do really good and do better than what your insurance premium would be, and there'll be some years you may have more losses, and so there's that uncertainty that goes with it. You also have the administrative requirements that we just mentioned, all those things that you might have to do that. You have the deferral of tax deductions. This is what I was talking about earlier, about that when you're self-insured, you cannot claim a tax deduction until you actually pay the claim or actually paid it. So even though you're reserving dollars, there's no tax deduction or there's no recognition of those payments until the payment is actually made to either an injured employee or payment for that. And then also there'll be some contractual requirements potentially that depending on, when you have you're doing a contract, they may say, okay, you need to have this much insurance. If your organization's self-insured, there can be some issues on some of the contractual requirements and be able to produce, a self-insured document. Now in the state of California, anyone that's self-insured will actually get a certificate of self-insurance, whether they're individually or as a group, and that's issued by the state of California. And so that's your documentation that you basically have insurance. And essentially every other state will have something like that. So a question that did come up, so can a self-insured plans be structured to control losses by imposing weight limitations and non-smoking restrictions on employees? Probably not to that degree, because that's going to be specifically on the weight limitations. But you can, for a self-insured group or others, you can certainly put some restrictions on, what type of claims are going to be paid, and probably the bigger, I'd say it's more from a joint powers insurance authority that you probably have it. I wouldn't call it a country club type of mentality, but you can certainly select what type of individuals or other cities you want to be in your pool. So you can put some restrictions, but specific, restrictions on employees. Let's say for workers' comp, for example, you have the laws of the state of California where you can't really do a whole lot, whether because of discrimination or just because of how payments type work. So probably not so much in that regard. Now you put requirements that they have to attend certain type of training to be covered or things like that. You might be able to, but essentially workers' comp is a no-fault system. You can be more aggressive in your investigations for those type of things, but as far as putting limitations or on that side of the house, that'd be more challenging. The other question is there a window for reporting IBNR claims, incurred but not reported claims? So you have to think about incurred but not reported. When we talk about a claim, it's really following what's allowed within state law for reporting, whether it be workers' comp or general liability. So from workers' comp perspective, I might say that 6 months after the close of a fiscal year, I say I got asbestosis or I had something that occurred earlier, and that's really where. So it would still be, as long as it's accepted within the laws, that's where the IBNR comes from. The other aspect of IBNR is that if I was, let's say I hurt my back, typically most doctors are going to have conservative treatment. They said strain or, certain type of thing, and I'm going to see a chiropractor, a physical therapist, something like that. Well, eventually, let's say I need surgery. Well, that $10,000 original claim because of surgery now becomes a $50,000 or $100,000 claim. That's IBNR right there. So IBNR is what we talked about when it takes 7 years to close a claim, where 95% of the costs are paid by year 4. IBNR probably you almost double a claim in the first year, and then you get smaller IBNR increases after that. So that's kind of where the IBNR kind of comes from, but it can happen at any point in time. Or IBNR can also be the fact that the employee is being treated and all of a sudden they get an attorney. That can then increase the reserves for the claim where they have to increase it, and that's another incurred but not reported type of aspect of it. We didn't have all the information at that point in time to fully be able to understand where the claim was going. So very good questions. So now we move on to, so before I actually move on to retrospective rating, what I do again encourage people to take a look at the Q&A that was sent out. There's really good questions on there that will help really walk you through some of the considerations and even kind of give some examples of what you might, some of the costs that might be associated with it. And so there's lots of, I think about almost 9 or 10 pages of kind of different questions. So certainly I would encourage you to take a look at that. So looks like David, you have a question. I'm going to go ahead and unmute your line. So David? You're live.
Hi, Eric. My question, when I read through this chapter in advance of the webinar tonight, I was freaking out because of all these formulas that I had to get my brain around. How well do we really need to know the formulas that are part of retrospective rating for our national exam?
So the formulas, actually I'm going to go ahead and tie this back up here. So the formulas basically on there are any type of formula typically they're going to provide for you. The main thing that you need to know is what's the difference between the different types of retrospective rating plans, and one that's what's based upon incurred and paid are the two different types that we're going to talk about tonight. But you're going to want to know what the terms are. So it's really important that you understand, basic premium, converted losses, excess on premium, because the formulas for the most part will be provided for you on there. And so that's where that's going to be part of that issue there. So I do another question did come in, or actually a comment, which does look like some audio issues. So and hopefully that's a challenge when you do a webinar in a hotel. You never know what the bandwidth, so more people must be online. So I do apologize. If I need to after this, if I need to re-record, I'll certainly do that and make that available for those if it does become an issue as we go on. But let me know if it gets really, really bad as we go on. So we'll go on to the retrospective rating and talk more about this and those key elements. But don't be overly concerned with formulas on here. I think as you go through, you'll see how this will basically work out as we move on here. So our objectives for Chapter 5 then are describe the purpose and operation of retrospective rating plans. So again, why do we even have them? Given a case, calculate the premium for a prospective rating plan. So here's the thing. When it says calculate the premium, it says, from an exam standpoint, given the case, they're going to expect that you can calculate the premium for that plan. They will provide the information and the formula, but you need to know, okay, when they say basic premium, what is that? Where does that go? So the exercises that are in the Q&A will certainly help with that. Be able to describe the following types of plans: incurred loss retrospective rating plan and a paid loss, and what the differences are for those two. And then describe the administration of retro rating plans, the advantages and disadvantages, and then finally a case study on there. So, so again, on the audio, well, hopefully, I may just have to record this when I get back again, but at least for those who are online, we'll go through this, and you can tell me some other areas I need to work on the program here. So thanks for everyone's patience there. So the purposes and operations. What is a retrospective rating plan? As it describes by definition, it's a hybrid risk financing plan in which an organization buys insurance subject to a rating formula that adjusts the premium after the end of the policy period based upon insured's actual losses during the policy period. So in plain English, what it basically means is that it's going to be based more on what my actual experience is. It's retroactive, so I'm going to pay a certain amount. They're going to take a look at my specific losses and say, okay, we're going to charge you more. We're going to give you money back or things like that. So it's kind of more in lines. It's not quite self-insurance, but it gets you. It's kind of the next step. So it's the baby step to eventually go to a self-insured plan. The other reason why you might do retrospective is that if you consider a guaranteed cost program, you're paying your $100,000 and you're done. There's no incentive for you to do risk control. A retrospective rating plan, like I said, it's the baby step, will then encourage you to do more type of risk control and eventually get you to probably where you can be self-insured at some point in time. So as it indicates, allows an organization that wants to retain more risk while keeping an insurance program, so you at least have some protection. And the insured's own losses will price the policy rather than industry standards. And so typically for, I think we may have not mentioned it, and the other one, it wasn't really highlighted in the book, is that if you're a contractor or you're a certain type of company, what will typically, like construction or roofing, they're going to base your pricing on what the industry averages are. And they'll use workers' comp insurance rating bureau class codes. and based upon what the occupations are. And so that's typically, your policy is going to be based upon what the industry is doing, whereas when you're self-insured or you're doing retrospective, it's really based upon your losses. It's what's actually happening to you. And so there's an advantage. If you're doing better than industry, then you should reap the benefits of that. As indicated, though, plans respond immediately to changes in the organization's loss experience, whether it be good or bad. And so therefore, you really have an incentive to have good risk control programs in place. And the reward is you're going to have lower premiums that much quicker. Typically used for low to medium severity losses. So again, you're probably looking at workers' comp on that. So the question just came up, is it called retrospective because at the end of the year, they retrospectively adjust your premium? Correct. So as we go through, you're going to see on the retrospective that they're going to calculate what your premium will be. And then, but then what they're going to do is they're going to do snapshots 18 months. So let's say we end of the year, and then they're going to do a snapshot at 18 months and maybe another again at 24 to determine whether they need to increase the amount of what they need to charge you or whether you paid your minimum premium. And you'll see that as we go through the rest of this presentation tonight. So the two types of plans that we'll talk about are incurred loss retro rating plan and then a paid loss. Now, the differences we'll talk about later, but an incurred loss, that means it includes paid plus reserves. So it's what the expected loss of the program is. Whereas a paid loss retro really is only looking at, you know, kind of going back to the self-insured. I paid out $5,000 for the claim. We're not concerned with the reserves under a paid loss retro plan, and so they're only looking at what's paid. The problem is that paid may be a lot more down the road, and there's a lot more uncertainty when you have a paid loss retro plan than an incurred loss. Again, it's not suited for small premium size. You know, so if you're a small organization, you know, mom and pop, you're not going to do this. You're going to be more medium sized, or where there's wide premium fluctuations, where, you know, things are changing, as well as for organizations that maybe have financial problems. So a good example might be auto dealerships. You know, during the last several years, with the decline, you know, an auto dealership would not want to do a retro because the sales and how things were occurring, people weren't buying cars. When those type of things, that may certainly affect whether they would be able to pay for claims, and an insurance company would certainly not want to do a retro plan with an organization that may be having financial difficulties or they perceive to have financial difficulties in the future. So just as have we kind of done before, you know, where would we have this? A loss severity retrospective plan would probably be in the low to medium type of severity, and then we would have you know, the retrospective would be here, and we have the excess would still be here. So we still have the plan. Excuse me, I misspoke there for a sec. So retrospective plan is going to be low to medium, and then the excess is still here, and that's where we would certainly look at those type of claims. So how do we determine premium? Well, experience rating, or what's called an X mod, for most companies, everyone typically has an X mod in the commercial market. And that experience modification is based upon the last 4 years, but excludes the most recent year. And the idea is how are you performing compared to everyone else? And what's considered average would be 1. So if your X mod was 1.25, means that you're going to pay 25% more than the average risk based upon this experience modification factor. If my X mod was 0.75, that means I'm going to pay about 25% less than that. So as it indicates in here, an X mod is not as important when we look at retrospective plans because it's, you know, and under this formula, it's a rating that adjusts premium for the current policy period to recognize the loss experience of the insured during the past policy years. So that would be under general plan. So and the reason why with a premium with an X mod, you know, a bad year can be part of the tail, and a retro plan, when you use a retro plan, because we're not using X mod, it's using your actual experience. We're not going to recognize those bad years as part of it. We're going to look at really the most recent year and make a plan, and then you're going to be paying claims either up or down based upon the year in which we're doing the retro plan for. So as it indicates, retro plans use a current policy year and adjust the losses. There's no averaging of losses. You know, that's what we do in an experience mod. It does basically averages losses over the last 4 years, does a regression, says this is what we predict, and we come up with an XMOD. And so that's why retro plans are attractive. So if you were an organization that was really having really bad losses and a really bad XMOD, but otherwise you said, we're going to be serious about risk control, we're going to hire these people, and so you're not paying a higher premium, you may want to switch to a retro plan, so that way you can get the advantages of that much quicker. And then actually good comment just came. Just as an observation, XMOD or EMR, experience modification rating, is a gauge that some companies use to gauge service contractors. And actually, that's a good point. I was in a conference this afternoon in which that very issue came up. That especially for construction firms, determination might be that you can't have an XMOD over 1.2. And the idea being that it's an indicator of your safety performance over a period of time. So an XMOD can have an effect not only for insurance premiums, but as someone that hires contractors, that may be a determination for pre-qualification of whether you can even bid on a project or be part of it. So whether you get points based upon your XMOD. So that's a very good point, that XMODs are being used somewhat like FICO scores. Of whether you're a good risk or not to loan money to, are you a good risk to work on our project, are you going to have a whole bunch of injuries? And it's even more important when you look at large organizations that may have what's called an OSIP, an owner-controlled insurance program, in which they're going to take on the risk of new construction. Some of the OSIPs, the most common would be actually the Bay Bridge, most recently, and actually another OSIP that was just formed in California is the High-Speed Rail Authority has formed an OSIP for the construction of the rail. So basically any of the contractors, any losses that are occurred with that are part of the loss of the OSIP. So it's to their advantage to make sure that they don't have contractors that have bad experience working on the project. So in general, how does a retrospective rating plan work? So what you're going to see in this chart is what it talks about is maximum, minimum, and loss and policy limits. And so we'll kind of walk through this graphic here. Again, if you can explain the graphic, you'll be able to, that's really the goal here, because it really explains what a retro plan is looking like. So within a retro plan, so it talks about under retrospective rating plan, a loss limit caps the amount of individual losses included in the determination of the retrospective rating premium, and the most the insured organization must pay under retrospective rating plan is specified as the maximum premium. So you're going to have a maximum premium, and then you're going to have certain loss limits as part of this. So in this case, here's a loss limit. Let's just call it $100,000. Might be the loss limit for each individual. And what that means is I'm going to, this is the losses that are retained losses, and anything above this, even under a plan, will get transferred. That means the insurance company is going to take these losses over the certain amount. So you can have a limit based upon a per loss specific, or you may have what's called an aggregate. So here's the maximum aggregate, meaning that if I have claims, once I reach the maximum point, then at some point the insurance company will then pay for these claims. So this will make more sense as we look at the other charts and probably look at numbers rather than just the graphics on this one. So when we look at a retrospective plan, the premium includes a couple things. There's going to be an estimated retained losses, and the insurer overhead and profits, residual market loadings, premium taxes, and then risk transfer premium that compensates the insurer for the risk of, and these type of things at the bottom. That an individual loss will fall between the loss limit and the policy limit. So this is the gamble that they're taking, and also for the total losses subject to the loss limit during the policy period that exceed the aggregate amount. So what they're talking about is there's a risk transfer premium, and that they're going to charge, making this is the insurance or extra money they're going to charge for the potential that you might have claims that basically pierce this layer or pierce over here, and that's where that concept is coming in. The estimated retained losses is what they predict what you're going to have to retain, that what you're going to end up paying. The overhead and profits, more specifically, is what that's my administrative cost to handle that, and I'm going to put some money, what I hopefully make part of my profits. That there's other taxes, and then there's other residual market loadings that might be part of this as well. So let's look. Here's a relationship between losses and premium for a retrospective plan. So you're going to have a minimum premium that no matter what, so under retrospective plan, you're going to have a minimum amount that you're going to have to pay. So we'll just throw some numbers out. Let's say the minimum amount is $100,000, and then I'm going to have a maximum premium of, let's say, $500,000 for my organization. So in between here is what I'm going to end up paying. So I know at a minimum, no matter what, even if I have no losses, I'm going to pay $100,000. If I have a whole bunch of losses, the most I'm going to pay once under the maximum premium scenario is going to be up this upper limit, and we'll show some formulas of the way this works in a moment. All right, and then under this layer, what this means is anything that's in here once we hit this limit is going to be transferred to the insurance company. So the retrospective rating insurance premium increases as losses increase. However, the premium cannot be less than the minimum premium or more than the maximum premium. So it gives me some confidence as I'm moving forward of, I know a range that I can sleep at night, that I'm not going to have losses above this. And at this point, it's the insurance company that's taking the gamble. But I know if I don't have losses, I'm going to benefit immediately from that by only paying this minimum amount by having good risk control. So that's the reason why you'd want to do a retrospective plan. So here's the concerns that were raised as far as, do I need to know the formula? So this is the basic formula that you'll want to basically know. And this will, in formulas, they do provide those, and it should be, I'll double check on the formula page to make sure that they do provide this for you. So under a retrospective rating insurance formula, this is what you're going to be calculating, which is going to be basic premium plus converted losses. So here, retrospective plan premium, this is how much we're going to charge you, is your basic premium plus converted losses plus your excess loss premium times a tax multiplier. And we'll show what this all means in detail in the next couple ones. So what's then your standard premium? So and this kind of goes to manual premium. You're going to see all these things. That standard premium equals your manual premium times your experience modification factor. So typically they're going to have what you would normally pay is what's your standard premium, and you'll see how all this works out in a moment. But so the standard premium is calculated by using state insurance department rating classifications. So that's what I talked about before. Your class codes based upon the type of occupations or the industry you're in, and then applying them to the insurance organization's estimated exposure for policy period. And this would be the amount that insured would pay for a guaranteed cost plan. So that's where we start from. What would you normally pay? And so if you think about that, if you say the normal rate for a roofer is, I'm going to charge $3.50 for every $100 in payroll. So essentially it's 3.5% is what I'm going to charge for that. For a secretary, maybe I'm only going to charge 80 cents for that type of organization. So that's where your standard premium basically comes into play, is they're going to do that, the manual rate, and then they'll also indicate what your base would be, and then they're also going to do your experience modification factor based on top of that as well, based on what you're doing. So okay, so the two questions, is the standard premium related to the basic premium? And basically the same question by two folks here. Standard premium is basic premium in the equation. Not quite. You'll see this in a moment on the next slide here, I believe. So, and actually in the equation you'll see how this kind of comes into the play between the tax, what basic premium and everything we're talking about. So basic premium covers the insurer acquisition expense, admin costs, overhead, profit, and insurance charge. So then we have to go, what's an insurance charge? That provides an insurer with premium to compensate for risk that the calculated retro premium may be higher than the max premium or lower than the minimum premium. So the insurance charge is really the minimum premium to compensate for the risk that's calculated. So the idea is that no matter what, it needs to have some money to pay for at least those type of things. So the basic premium covers the insurance acquisition, admin, overhead, profit, and the insurance charge. So that's where the basic premium comes in. The insurance charge includes these, when we talk about, includes these elements that no matter what, this is what they need to make just to be able to operate. That's where the insurance charge comes in. The converted losses is the product of incurred losses and a loss conversion factor. So you'll see this in a moment when we go to the equation. So it's the product. So we're going to multiply how much did we incur and a loss conversion factor, so that we can come up with a number of what those expected losses. It's like your loss development factors, kind of basically what we're looking at. And so here's the loss conversion factor, is a factor applied to incurred losses. Okay, so the converted losses reflect loss adjustment expenses. So when we talked about loss development factors, this is kind of the same idea, is that we can have an incurred loss and we say, okay, we're going to pay $100,000. Well, there's a certain amount of money that costs to adjust that claim. And maybe it's 10% of the claim we project that's what it's going to cost for me to pay for my adjusters, to pay for the other expenses that deal with the admin and overhead. So that's what that loss conversion factor will help, will cover some of those type of elements there. We also have what's called an excess loss premium, which compensates the insurer for the risk that an individual's loss will exceed the loss limit. So in this example, what they indicate is the standard premium. So, we'll go over the example here, times the excess loss premium factor times a loss conversion factor. So now we're multiplying all these elements together. So in the example, they say, for example, if the standard premium is $600,000, meaning this is what you'd pay under if you're going to do the commercial insurance rating, the excess loss premium factor is 15%. Okay, so that's this number. And the loss conversion factor is 1.25. So the excess loss premium is $112,500, which is $600,000 times the 15% times the 1.25. So on top of, so the excess loss premium that we're going to charge for this is going to be $112,500. And this is what we'll add on at the very end as part of our protection for this type of policy. And then finally, you have a tax multiplier, which covers the insurer's cost for state premium taxes, license fees, insurance organization assessments, and residual market loading the insurer must pay for on all collected premiums. So the idea is that if the state requires that I have to pay, as an insurance company, certain fees to the state to be able to operate, that's what this tax multiplier is including in there, any type of assessments from the state. And then finally, you have maximum and minimum premiums are expressed as a percentage of the standard premium. So when we talk about the standard premium is $600,000, then we're going to have it's going to be a percentage that I'm going to be 50% is maybe half of that will be the minimum premium, and the max may be 150%. So in this case, if we use the $600,000 and it says that I have a 50% minimum premium, that means at a minimum I will be paying $300,000 for this policy. At a maximum, I would be paying $900,000 for the specific policy. Okay. All right. So it looks like the question was answered there. So we're going to go on, and you'll see how all these things work with these things. Then you're also going to have other things for premium adjustments at different time periods. So these are all kind of definitions of you need to know of what makes up a retrospective rating plan. So a lot of details, unfortunately, as part of this. So you have your deposit premium, which you're going to pay at the beginning of the policy term, and it's usually going to be equal to the standard premium. So if we say in this example $600,000, that's what I'm going to pay up front, because that's what the projection is that I would need to pay. And it's based upon what are the estimated exposures at that time. Now, there's going to be what's called evaluation periods, and there might be probably 2 or 3 evaluation periods depending on the type of plan. So the first one's going to be done at the end of the policy period. So at the end of 12 months, I'm going to do an evaluation, and then we're going to adjust the premium on the actual exposure at that point, or adjust the premium based on actual incurred losses, depending on what type of program that we have. And it's also going to account for what the insurer has already paid in premium. And then what's going to happen, adjustments are going to continue until all the retained losses are paid or both parties agree to go to no further adjustments. So depending on that they say, okay, we're paid 95% of the cost, we'll just estimate it and we agree that we're done, or all the retained losses are paid. And you'll see the examples as we go through some of these other pages here with the examples. And we'll go back to that question about, basic premium. What does that really mean here in a moment? So here we have, this is between an incurred loss and premium adjustment. So incurred means it includes both reserves and paid. And this, what they're showing here is probably a fairly common thing. So here's our cumulative losses, incurred losses over time. So this is 0. All of a sudden, we cumulative. We have a another $5,000 claim, and it keeps on adding up. And here's where we are over this period of time. This is the cumulative paid premium. So this is your standard premium that essentially that we've had at this point. So of what we paid over this time period. Now at the end of the policy year, essentially what I've been charged. And so if you look at why is this going stair step? If you look at this first quarter, second quarter, third quarter, fourth quarter, when you pay an insurance premium, just like with your auto insurance, most likely you pay it either a quarterly or monthly basis. So the $600,000 as an example, I'm paying it over a period of time, and at the end of the year, I'm going to have paid my full $600,000. And so this is the first part. Now at some point we're going to do an evaluation. So here's the first evaluation period, right here. And what they're showing on here is that based upon this, I paid my $600,000, but look, my losses haven't reached that. And so what they're going to do is they may return the premium back to me at this point. If it looks like my claims are developing a certain way. Well, then another point about, let's say another 6 or another year later, they'll do an evaluation again. And what they determine is, oh my gosh, look, these claims, we had more claims that came in. Guess what? We're going to have to now increase additional premium. So at this point, they return the premium at evaluation point 1, and then you got charged again because your experience kept on going. That is not uncommon on these type of programs, to where you might have something look really good and then things change because all of a sudden the claim got litigated, and that's where this additional premium might come into point. So what you want to be able to describe here, what's going on. Here's your premium payments over a course of a year quarterly. I paid my full money. I have an evaluation period. At this point, I'm looking good. At this point, second evaluation, things are not looking so good, and then we run into issues there. So this is an incurred loss situation. So now this is where and this is where I was kind of going, the basic premium compared to standard premium, of how we would get to it. So the basic premium didn't really have a description other than it's going to be a percentage of the standard premium, and they will give you the facts. So if you have an example like this, most likely you'll have a question that would have all this information. So they're going to give you all this, and then what you'll have to do is kind of make sense of it to say, okay, what does this really mean? And what I really encourage you to do when you have something like this is draw a picture, because it really makes it'll be easier to understand. So in this case facts, it says, assume that Canston Manufacturing Company has the cost factors for its incurred loss retrospective rating plan. So the policy limit is $1 million per occurrence. So meaning that any one claim at $1 million, they'll pick up, they have the responsibility for picking up the rest on that occurrance. The standard premium is $700,000. The premium discount for this one is $50,000, and they didn't really say on the premium discount on there. Just double checking here that they're going to give a premium discount for doing this policy of $50,000. The basic premium is 20% of the standard premium. So the standard premium is $700,000. So that means my basic premium in this case would be, what is that, $140,000 less, or $140,000 would be my basic premium. The loss conversion factor is 1.10. This is what it's going to be. So 10% charge for each claim is what I'm going to be charged for to help kind of manage the claim. That's the cost you're putting in there. The loss limit is, in this case, $500,000 per occurrence. So actually, I need to step back on here. They actually included this. This shouldn't say policy limit per occurrence. It should have been $1 million, or $1 million total is the policy limit on this. The loss limit on this one is $500,000 per occurrence. So each claim in this case would be $500,000. The most I would pay for each individual loss. The excess loss premium factor is additional 5%. And again, going back to the definitions of basically what a excess loss premium factor, that's what they're going to charge for make sure I got it right here, the loss conversion factor, and plus those things that I'm going to have to pay, for this is the risk I'm taking on, by doing this. So I'm going to charge an extra 5% for taking on this with the potential that you're going to have claims that exceed the policy limit. And then finally, you're going to have a tax multiplier. This is 4%. This is what the state is basically charging for me to do business. And then finally, here's the maximum premium of standard. So in this case, you're going to have a minimum premium of 40%, meaning 40% of 700,000? Do math in my head. What is that? 280,000, or the reduction, what that would be. And then the most I'm going to pay is 150% of that 700,000. So that kind of gives you an idea of how this works. All the numbers they're going to give you should be fairly simple math for you to be able to do, but you just have to know what each one of these things means. So the analysis that they're going to provide, and we'll go through each one of these in a little more detail here, is so the standard premium of $700,000 minus the premium discount of $50,000. So $650,000 is the amount that cancer would pay for a guaranteed cost insurance program. So if we just did guaranteed cost, that's what it would cost us. So that's kind of what we want to do the comparison. The basic premium is 20% of standard premium, or $140,000. So again, the basic premium includes an insurance charge. That's going to be included in that. So, and then the excess loss premium is 5% of the standard premium. So, of the standard premium times the 1.1 loss conversion factor of 38,500. And so this excess loss premium, this is the insurance company's kind of extra little cushion that they want to put in there just in case claims go bad. And then the maximum premium is 150% of the standard premium, or so the most I'm going to pay under this is about $1 million, $1,550,000, and the minimum premium is going to be $280,000. So the advantage is, if I would normally pay $650 for this policy, but if I do really good, I'm only going to have to pay $280,000 based upon my loss experience. So in this case, using the retrospective rating insurance premium form, the retrospective rating plan premium is calculated as follows. So it's going to be $140,000. So if I go back, let me see if I can go back to the chart here. So the $140,000 is the basic premium. Let me go back to the formula. So right here, this is what we're doing right now. The premium, this is how we calculate the premium. It's going to be the basic premium plus converted losses, excess loss premium times that tax multiplier. So we have the $140,000 plus my losses times that 1.10 plus the 38,500 for the excess loss premium, and times the 1.04, which in this case would be, that is our tax, that goes back to the tax multiplier that's on there. Now the reason why we don't have losses put in there is because we don't know our losses yet, because until the end of the year, it's going to be based upon the actual loss experience. So this is the most, based upon this is the most I'd pay, the $140,000 plus the additional amount. But the minimum premium I know at this point would at least be $280,000. But this helps us decide what that premium would be as far as that. So using this, so here's the example. So here's the formula that we just mentioned here. So using the retrospective rating plan premium formula, the table shows retrospective rating plan premiums for various incurred loss amounts. So if we had $50,000 of losses, so if we put that $50,000 in here, most likely if you add that up, we're going to come up a little bit shy of probably $280,000. It's going to be less than $280,000. So if we only have 50,000 losses, we're still going to pay that minimum premium no matter what. Okay. If we have 100,000 in losses, and I put this in the formula, so in there we have our basic premium of 140,000, and we do our converted losses of the 1.10 times this. The number we're going to end up with is about 300,040, and so you can kind of basically go through here that depending on our loss level, if we have 800,000, the max we're going to pay is $1,050,000. So that's where the formula comes into play. So hopefully that takes a lot to make sense on there. So the question I do have is 150,000 of 1 million should be should be 1,500,000, not 1,050,000. So let me see here. So the question is, oh, okay, but the 150%, actually the 150% that you're questioning is 150% of the 700,000 is what we're looking at. 150%, so 50% of that is 350,000. So so that's where we're getting that number there. So it's going to be 1 million. Yeah, so that's where that number would come in. It's 350,000 on top of this number, which would be the 1,050,000. So that's where that $1 million number is coming from. But good question, because I can see how that can be a little confusing there. So the most we would pay is this amount. So this is one of the things you're going to kind of have to practice. But you know, if you look at this and you kind of add it up, put it in the formulas, you'll see how all these numbers are calculated and why a retrospective plan would work the way that it does. So having that basic understanding of the formula. So let's kind of go back here. The main thing you need to know to be able to do this, they're going to give you the information on something like this. You need to be able to take this information and with the formula understand the basic premium, converted losses, this, and be able to do something very similar to this type of aspect. That's what you need to be able to do for the exam. So the formula will be provided. You just need to understand how the different pieces work and be able to do what I would consider some not too heavy math, but it'd be something you should even be able to do on paper if you needed to. So now the two types of retro plans that you need to be concerned with, and at least the aspects of how they operate from an insurance standpoint, is your incurred loss retro plan, which is where the insurer adjusts the premium based on the insured organization's actual incurred losses, and this would probably be the most common. And by doing this, the insurer does not receive cash flow benefit since the insurer is now holding the money. Okay, they're going to hold that money because it's from that aspect. Or the insured does not receive cash flow benefit, I should say. There's a typo there. The insured does not receive cash flow benefit since the insurer holds the money. Under a paid loss retro plan, the insured pays a deposit premium. Okay, so I'm going to pay a deposit premium, and then and reimburses the insurer losses are paid by the insured to the claimants. So if all of a sudden I have a claim and it's 50,000 more, I'm going to then write a check to 50,000 more for the insurance company as the claims are paid. So I'm going to pay this amount as claims are actually paid, whereas here I'm actually paying the premium, pretty much the full amount of that whole year up front. In this case, the insured is required to provide some form of security to pay for future claims. So they're going to have a surety bond or some type of certificate to basically say that they're going to have enough money to pay for these claims as they come due, whereas here they're paying either most likely on a quarterly basis for those insurance premiums. So here's what it would look like with these two examples. So this is a loss between losses and premium payments for an incurred loss program. This is the most common. So you can kind of see that under cumulative loss, these, the first year I'm going to be paying this much. Well, as we know with a typical workers' comp program, the reserves and everything might be up here. So this is reserved and paid, but what I actually paid is probably down here. So the accumulation of those losses. But over a period of time, they're going to end up connecting. The idea with cumulative loss, at some point, as I pay more, my reserves are going less, and at some point they're going to connect. And then you can see where, assuming here's your cumulative paid premium, I'm paying my premium, and then at some point we have an evaluation period. They look at it, and then I have to pay a little bit more because another evaluation period. And so you can see how these claims basically develop of the maximum premium. In this case, I paid my max because the claims eventually exceeded the amount for that policy period. Now here's one that's looking for a paid loss program, and so here's a little differently where we're going to look at it, is that here is the cumulative paid losses, so this is what the insurance company pays. Now the incurred losses, this is the same chart. The incurred, the reserves are, with paid plus reserves are all up here, but because I'm only paid my paid losses, you can see that this line basically stays exactly parallel with this one. You're saying, well, why isn't it the same line? Because I still had to pay my basic premium, my deposit premium. I had to pay at least that $140,000 in the beginning. And so now I'm just paying as each payment's made, I keep on paying that amount until at some point I may plateau if I did reach my maximum premium period. So those are the two examples of how they would basically interact. So here's another example of a comparison under the two different plans. So if we use that same type of information we had before of an incurred loss and then a paid program here, the policy limit is going to be the same, $1 million. The standard premium is $700,000. So I'm going to still pay the same standard premium. The basic premium in this case is 20% of the standard premium. Under a paid loss, I'm going to pay a little bit more, basically under a paid loss retrospective plan. Most likely a little bit higher percentage would typically work for that. The loss conversion factor, as you can see, all these other things are pretty much the same. Now the maximum premium, I'm going to pay a little bit more on the standard, right here. I'm paying another 8% just like I did here. So for the most part, the cost of them is probably the same, but the basic premium for doing a paid loss retrospective is going to cost me more. So why would you want to do a paid loss? Is because you get the cash flow benefits, but for that cash flow benefit, you're going to pay a little bit higher standard premium and possibly a higher maximum premium to have that cash flow benefit. So that's why where you see the incurred loss retrospective, really a more common type program. It's a little more stable in many respects. So the administration of these plans that you need to be concerned about is collateral requirements. You're going to require letters of credit, either certificates of deposit or forced rights of escrows, essentially meaning that if something happens, they get the money first before anyone else. There's a cost associated with maintaining the collateral. So if you want to borrow money or if you have a security, there's a cost, a certain premium that's going to be charged for that. And when you do that, credit rating becomes really important. If you have a low credit rating, you're going to pay more to borrow those type of monies to get that certificate or that security requirement as part of that. Financial accounting issues. So the challenge here is you must recognize retained losses as they occur. So you're going to have to show that as a liability. So even under a retrospective plan, as claims occur, those retained losses over a period of time, you're going to have to show that as liability on your books. You may also need to recognize IBNR, meaning that these claims may exceed a certain point. So even though you're only paying, let's say, on the $700,000, you pay $200,000, that claim may grow over a period of time. So you're still going to need to recognize the potential for the IBNR on your financial accounting. And then under a paid retro plan, you may need to calculate incurred losses for financial reporting purposes. So even though you're only paying out that certain aspect, the incurred losses, you may still need to take that into account of what the total liability really is to the organization, depending on the financial reporting requirements for the organization. The tax treatment, incurred plan, you can deduct premiums when they're paid. So as you pay your premiums, you pay your deposit premium and you keep on paying those, you'll be able to deduct it. Whereas when you do a paid plan, you only allow it when you actually set aside to deduct funds that are set aside for retained losses. Or excuse me, does not allow an organization to deduct funds set aside for retained losses, meaning when you pay the claims, that's when you actually get to deduct, have that tax deduction. And then the other issue is exit strategy. So under a lot of these programs, because you have your evaluation periods, and this happens with self-insured groups and others, let's say you decide that you go back to a guaranteed cost program after you did 2 years of a retro. Because you're still beholden to the retro plan, and if costs continue to increase, you may still have to pay for the policy even after you've changed programs. And that's something that when you explain that to a owner of a company, they really don't like that. To them it's a surprise because they're so used to guaranteed costs, they feel that they paid it. And so that has to be explained under retro program, that until those years close out, until it's agreed upon, you still may be held liable for those changes in evaluation periods. So the advantages, when you look at this, obviously in the long run, costs tend to be lower than cost of transfer, cost of buying a guaranteed program. It definitely encourages risk control, and if designed properly, provides many of the advantages of risk transfer by doing so. The disadvantages, as you can see there, financial planning may be difficult if it's not designed properly. The possibility of inflated reserves, because the insurance company would still be managing some of these, the reserves could certainly affect the cash flow. There's less of an advantage, again, with an insurance program. They may not diligently adjust the losses, meaning, how are they closing out claims quickly, those type of things, because it's to their advantage to keep the claims open to a certain extent. And then also premium taxes and residual market loadings add more to the expenses because of the, they're taking on more risk. They're going to charge you for that, and so there may be less advantages in some cases as well. This is probably one of the key things I would just kind of highlight, talks about selecting what the considerations, why you'd want to look at a retrospective plan, and the 2 bullet points there. Retrospective plan, rating plan selection is a function of insurance marketplace conditions and is influenced by who is assisting the risk management professional in developing the program. What it means there is a broker helping you, who's doing the plan, and what it talks about marketplace conditions, is it a hard or soft market? Depending on the market conditions, there's advantages in some years of doing retro plans. In some years, it may be better to do a guaranteed cost. And so what we're talking about here is the influence that a broker may have, or whoever they're giving advice on that. And then also the retrospective plan selection is usually based on an in-depth analysis of the insured organization's historical loss experiences and financial conditions, as well as subjective factors as senior management's risk aversion. So risk aversion or risk appetite might be another word you might want to use there as well. So it's got to be based upon historical losses, as well as can the company financially take on and do a program like this? Do they have enough money in reserves to take on the risk to essentially do a retrospective plan? And then finally, the last couple slides here is this is a comparison of a couple different plans based upon some different scenarios, and they have $200,000 each accident. What this might look like, with a basic premium, or the plan factors, with basic, and you can kind of see what the multipliers are. That the basic premium would be 0.375. This one's 0.325. I guess that's the other thing. The basic, how they calculate the basic premium, as you saw before, is like 0.4. These numbers will be given to you. It's not something you're going to have to calculate to say, okay, how do I calculate what the basic premium factor would be? So the plan factor for basic factor, you can kind of see that the essentially, well, at least on the 300,000, this one has a little bit lower. The tax multiplier is for the most part the same. The loss conversion factor, the idea is the higher, well, you can see this is higher, this is in the middle, how these conversion factors kind of play based upon where you're going. And then the maximum premium in this case for 300,000 is 1.8. It's higher than 1.5, so you're paying more to take on accidents that are higher cost on those. And again, you can kind of see some of those. It looks like we do have a question that came up here. Okay, and it looks like the very bottom of the slide might be cut off here, so I'll see what I can do here to show that. So hopefully I'll make this way so people can see the bottom of the slide. And maybe just move this up just a little bit more there. Okay. So apologize for the slide being cut off there. Hopefully that works a little bit better. And then the excess loss premiums, you can see the example. So the excess loss premiums and standard premiums that are charged. So the standard premium is going to be 1.2 million. That's the standard. And then the excess loss premium will certainly be a part of that as well. And then the minimum premium in this case, based upon each of these scenarios, you can see the least amount that I would pay for each one. The 300,000 would be 425, so that's a good deal. But the problem is the maximum premium is 2.1 million. So just as you get, with risk comes reward. In this case, depending on where your losses are, you're also taking on that you may pay a lot more. And then the other factors, 12 monthly payments at 103,097. And so this just gives you an idea of how a risk manager would be given these scenarios, and then you'd have to make a decision and say, okay, can I sleep at night? What am I willing to do? And if we had the maximum loss, do we have money to pay for these claims? Whereas the standard premium would be $1.2 million. I'm basically taking on the risk that I might have to pay $2.1 million. So that's the gamble. And so the idea is if you have good risk control, you're going to be willing to take this bet, and you'll come to the advantage of essentially of almost $800,000 to the advantages by doing that. So if you get a question, you may get something saying, what would be the best, which program would you pick, or which one would you need to have consideration for the minimum premium, or which one has the lowest minimum premium between the two. Something like that might be some of the questions you might see from an exam standpoint. And then lastly, here's the key things, the steps of selecting a plan. First, determine which coverages to include in the retrospective rating plan. Again, when we talk about coverages, what workers' comp, what type of program. Determine the limit to which the retrospective rating plan will apply. Determine the loss limitations of any, and then finally determine the maximum and minimum premiums are really the key component. And so going back to this, when you look at what are the key factors are, maximum, minimum, we're looking at what type of program, what's our loss limitations is up to $300,000 per accident will be covered. Those are the types of things that this is basically talking about when you want to look at a plan to be able to evaluate which one's really the best for your organization. So with that, I want to thank everyone. If there's any questions, go ahead and we'll go ahead and take those now. And again, thanks everyone for the participation. We will have a break next week due to the holiday, and so then we'll be reconvening the following week after that. So if there's no questions, oh, we do have one. Looks like, okay. Looks like we got that. All right. Looks like everyone's good. I want to thank everyone again, and we'll reconvene in 2 weeks. Have a great night.